Howdy. Welcome back to Dion Talk. This is going to be a nice short live that I do on my phone, so I'm not going to be able to answer any questions during the live, but I will answer questions in the comments below after. Why real estate prices may spike and go up in the next few weeks. I hear a lot of people talk, and have talked about this for years, that when interest rates go up, prices go down. If interest rates go up 1%, prices will go down 10%. That's the metric that we hear often. And actually what happens is if interest rates go up 1%, buying power goes down 10%. You can actually see prices go up when interest rates go up. It doesn't increase demand. It doesn't mean that there's more buyers. People are backing off. We're seeing demand be decimated. But an example of this right now is the numbers for Seattle. And Beth Traverso and Michael Zuber talked about this on One Rental at a Time the other day, so I did a little bit of research. And in Seattle, we have seen, since interest rates have gone up so much more than last year, 48% less transactions year over year. So 48% less transactions in that market. You would think interest rates went up, so there's less deals happening, prices must go down. They're up 11% year over year. Prices can go up when interest rates go up, but buying power goes down. So you eliminate a lot of the people trying to get into real estate. You end up with more cash buyers, more 1031 exchanges, more other ways of getting into real estate that don't take borrowing as much money at these higher interest rates. But here's where the reason why property prices could spike in the next few weeks. Interest rates are high. The Fed keeps raising. They've gone up 75 basis points several times in a row. And so we've seen rates basically double in the last 6 months, probably even more than that. I'm not doing the exact math. But with interest rates going up that much, lenders have raised their rates too. So while the Fed rate is higher than it was, banks were lending at 7 or 8% for the last month or so, which killed demand. Less deals happening, but prices were not really coming down as fast as we hoped. I did see some prices listed with price drops from their wish list pricing, still up even in my market, over 7% year over year from this time last year. But here's why those prices are probably going to go up in the next few weeks. CPI came out and it was better than expected. So if inflation gets worse, the Fed has to be more aggressive. If inflation starts to look a little better, the Fed doesn't need to be as aggressive. So lending fear is bigger when we think the Fed is going to raise rates more. The Fed has to be more aggressive on lending, and high inflation means that lenders want a bigger margin between what the Fed rate is and what the lending rate is for mortgages, because they're not the same. The mortgages don't lend out at what the Fed rate is. The Fed rate can go up or down, and then lending will, if lending fear is really high, they increase that gap. So if the Fed rate is 3% and lenders are doing 6 or 7%, that means there's a 3 or 4% gap between the Fed rate and what lenders are lending at. That's a big margin. Usually that margin is only 1.5% to 2%. Well, with a good CPI rating or score coming in where it looks like inflation isn't quite getting worse, it isn't best, it's a little better, the Fed is using their toolbox correctly, and some things are getting better. So lending fear will get less, which means they might compress. It's called compression. The gap between what the Fed rate is and what lenders lend at might get closer together, which means we could see, which we're seeing now, interest rates in the 6s, where a month ago we were seeing in the 7s, and investors are usually higher. Small multifamily is even higher, so you get a better interest rate if you're owner occupying, and a better interest rate for single family. So you could have maybe been seeing 8s, but now we're seeing lenders today make posts on social media saying, "Hey, we have mortgages in the 6% range. Jump on board." Here's the thing that is true about the statement that I hear incorrectly often. People say, and I've heard this a lot, and I've actually heard Meet Kevin for like the last 2 or 3 months actually say it right. He said, yes, if interest rates go up 1%, buying power, not prices, but buying power goes down 10%. The inverse isn't the same. If interest rates go down, not just buying power goes up, but prices go up. Right now, if you're looking at the market and you're thinking, like some of the people I know, I would buy if prices were the same as they were last year, I would jump on it. Would you with current interest rates? because you didn't buy that one last year, but would you with the current interest rates? Well, now we see the prices are too high and the interest rates are too high. So the home buyer isn't buying because the payment's too high. The investor's not buying because the yield's not high enough. And now, if interest rates are all of a sudden in the 6s or the 5s, the demand will spike, which will mean if you're a seller, Julie, and you have a property that hasn't been getting a lot of attention, this is the time in the next few weeks where you might see that attention. If you're going to sell, this is the time to list, because the average buyer is going to say, wow, interest rates are down, because lenders will compress that difference between Fed rate and lending rate, because lending confidence is stronger. So this was just a nice short live to talk about why home values are probably going to spike in the next few weeks. That doesn't mean that I see them going up a whole bunch in the next few months, but this is just if you can act quickly. If you're a seller, this is the time to sell. If you are a buyer, if you're like a lot of investors, you're thinking, if interest rates would come down, I would jump on my deal, which means everyone else is going to too, which is going to increase demand, which pulls us further away from a buyer's market into a seller's market, where you might not get the seller to buy down your rate. You might not get the seller to pay your closing costs. You might, I don't ever recommend, have to waive contingencies, but there were investors that were doing that. Not my strategy, but that's something that people were doing for a few weeks, because who knows what inflation is going to do in December, and who knows what the Fed is going to do in December. Don't invest like you have a working crystal ball, but invest on the data that you have currently. And what we have currently is a good CPI report, and good news is bad news, which means lenders are going to lower rates, which means good news is bad news. When they lower rates, it's the time to buy for everyone, increasing demand, making the prices go up. So I look forward to seeing anybody that's going to be at the One Rental at a Time meetup on the 12th, which is in 2 days, in Fresno, California. I hope to see you there. If not, thank you all very much for showing up for this really quick live stream where I didn't have a chance to answer questions, but I will be doing a few live streams next week, because I'm going to be spending some time in California, and to distract myself from being in that terrible state, I will be doing some live streams. Until my next video, thanks for coming to my Dion Talk.